Atsi, good morning. Thank you for joining us. I looked at the data and optimistic like me also finding it hard to really pick up the good parts.
Well, I have a slightly different view from you, I'm afraid. One thing to look at the data is, look, this is 7% GDP growth. This is still higher than most other emerging markets at this point. And the second point I want to make is that this 7% GDP growth was achieved with a severe reduction in inflation. So the point I want to make is that, look, India had an inflation problem. It didn't have a growth problem. India's growth has always been above its peer level. It remains above its peer level. What India had a problem with was inflation. Bringing down inflation from above peer levels to below peer level was the challenge. The Indian economy managed to do that without giving up a significant amount of growth. So from my perspective, which is the macroeconomic balance perspective, this is actually a good sign that growth didn't decelerate that much, but inflation did.
So, Atsi, what is your own assessment of the revival that we've seen in crude prices, considering we've perked up quite a fair bit, almost about 27% in just the last 3 days or so, and we're already sitting at a 6-week high? Because if crude prices actually reverse, that's not going to be good news for markets like India.
It's not going to be good news for markets, and it's also probably not going to be good news for the Indian economy. But to put the crude price in perspective, this revival over the last few weeks is really after a significant downturn compared to the last year. So crude prices are still much lower than previous peaks and much lower than their previous averages as well. Having said that, yes, if crude oil went back to previous averages or previous peaks, the macroeconomic balance that India has achieved, which is still fairly high growth and fairly low inflation, that would probably turn around. So that is a risk. At this time, our baseline is that that risk is unlikely to crystallize over the next year, given how low domestic demand is around the rest of the world.
Let's see, again, let me be a contrarian here. If I look at the core data which has come for the quarter gone by, that's not looking impressive. The fiscal deficit has gone up, which means government's commitment towards spending has moved up. Somehow the government spending has not translated into a huge pickup in the investment cycle. And that, to my mind, is a big area, is a big grey area of concern.
I think that's an interesting analytic point, because I think in the years gone by, there was a sense that India benefited from a huge fiscal multiplier, that for every rupee that the government spent, you could get X amount of rupees of growth. What you've seen in the first quarter of this fiscal year is that has not been the case. And I think there were some offsetting factors to consider here as well, that yes, government spending actually did support growth. If you look at where domestic demand, particularly consumption, has gone, consumption was actually fairly robust, and that's where the fiscal impact is felt most. Where even with the capital spending, remember, capital spending is still a much smaller part of total government spending than current spending. So it didn't have that much of an effect on investment. The offsetting factors against this sort of fiscal push or fiscal stimulus was, of course, the global environment. You look at how exports performed, and they were a big drag on growth. And I think this also challenges one of the conventional wisdoms about India, that it's relatively insulated from global trends, especially with respect to exports and growth. You see that lower exports do affect particularly manufacturing in India, and that's what you're seeing here. Second, what you're seeing is that the monsoon has an impact. We had a very weak monsoon outturn last year. This year too, it's been weak, and you see that in terms of the push that it provides to rural incomes, in terms of agricultural output, and in terms of the overall environment. So I think those two factors need to be highlighted here, that the fiscal push was there, but it was offset by exports and a weak agricultural outlook.
Atsi, that of course is the domestic picture. Let's come to the global data points which seem to be shaking the world right now. How systemic a problem is China for markets like India?
Well, there's two ways in which China affects the rest of the world, emerging markets in particular. One, of course, is the real impact. China is a large importer. It's a large consumer of commodities. So it does have an impact on real growth and output and export trends around the world. India, being not a commodity exporter or a big exporter to China, is relatively insulated from the Chinese slowdown itself. Although in the sense that China affects the rest of the world, of course, India, as we've discussed before, is not insulated. Where I think Indian or the Indian economy does have some vulnerability is in the financial market impact that China's slowdown has. We've seen in the last few weeks that capital markets have been relatively volatile, with different points of data coming out from China. And that, of course, has had impact on sentiment, risk sentiment in general, risk sentiment specifically towards emerging markets, and then, of course, risk sentiment towards current account deficit countries, which India is. So I think India will have some exposure to the slowdown in China, not so much from the real channel, but from the financial channel.
You know, it's easy to pinpoint 2 or 3 large pockets of economic growth, and one of that is India. So considering that India has emerged as the destination of choice for global investors, do you think in the short term India will attract disproportionate amount of flows both in the FDI in the FDI circle and in the equity circle?
Well, India has always, over the last 10 years, if you look at India's growth performance, it has outperformed most peers, bar China until recently. And yet it didn't attract as much FDI as you saw flowing to other segments, say Malaysia or Indonesia come to mind. And one of the reasons was how hospitable the operating environment is in India. So I think growth alone is not enough to attract FDI. Making the operating environment more hospitable to foreign investors is the other aspect. Making the infrastructure environment stronger than it currently is would be a third aspect, I think. And so India outperforms on growth, but on the other two, I think it is still a little bit short of its peers.
Atsi, given the macro environment that we're in right now, do you think the Reserve Bank has room for further easing? I mean, the governor himself has said that, there is definitely room. They're watching all the parameters. I'm just raising question marks because of the GDP data that came in last evening.
Sure. Yeah, as you know, we had revised our forecast for this year's GDP down to 7% before the data, I might add. And that was because we did see that the recovery in real indicators, as you've alluded to before, has been, quite weaker than anticipated. So purely from the domestic perspective, if you look at how much inflation has come down and how much growth has been slow to recover, there is a case to be made for further monetary stimulus, especially given the limits of fiscal stimulus at this point, that A, it's not having as much of a multiplier effect, and B, the fiscal deficit itself is too high for the government to do much more than it has. So there is a case from a domestic perspective. But I think it really depends on how much the RBI will weigh this sort of domestic argument for stimulus against the argument that, look, there is still capital market volatility, and lowering interest rates right now might put pressure either on the balance of payments or on the exchange rate, and that might be something that the RBI might want to avoid. A second factor, which was discussed a little bit more earlier but has died down in the public debate, is whether food prices will rear their head again towards the end of the year. And again, this will depend on whether the RBI sees inflation as stable and within its target over the coming year or so, or whether it sees food prices as a risk. So I think that will determine what the RBI will do come September 29th, I guess.
So what's the India view then, Atsi, right now? Is there a rating change up on the anvil, or would you say it's status quo because things haven't really changed much?
What we did this April is we put a positive outlook on India's Baa3 rating. And this was with a view that, look, over the next about 12 to 18 months, you are likely to see a gradual improvement in India's credit profile. That was our view in April. After putting that positive outlook on, we have actually revised growth down. We revised it from 7.5% this year to 7%. But our view on the rating remains unchanged. We see this downward revision in growth as a price to be paid for macroeconomic balance. That this downward revision in growth has come with stronger inflation and stronger current account deficit numbers, continued fiscal consolidation. So on balance, we think India's macroeconomic condition now in 2015 is much stronger than it was in 2013. It even looks stronger than some of its similarly rated peers. The key to determining whether the profile is a Baa3, which is the current level, or one notch up, is the extent to which reforms can address two outstanding issues. One is India's infrastructure deficit, the way reforms can put in motion for this deficit to be addressed not in the immediate, not in the next year or two, but over the next 3 to 5 years, whether those wheels are put in motion or not this year. And second is the operating and regulatory environment, whether the complexity that currently thwarts investment to some degree is actually simplified and liberalized. I think those two will determine whether the rating moves up or not.
Atsi, appreciate your time. Thank you for joining us.